You and I are told time and again that the stock market is volatile. It's a given fact. But why is the market so topsy and turvy? Nobody explains that. How can a stock that was worth rupees 100 just a few days back can suddenly turn to rupees 50 or maybe 150? Understanding about the market volatility is quite important. If you don't understand what goes behind these movements, the market roller coaster could shake you right out of your investments faster than you can imagine. And if you buy or sell based on your emotional reaction to these movements, it can be a disaster. So let's make sure that it doesn't happen to you by putting the stock market volatility under the hammer today. So let's start with brushing up our basics first. Stock market volatility is a measure of how much the stock market's overall value fluctuates up and down. Stock market volatility can pick up when external events create uncertainty. For example, the major stock indices typically don't move more than 1% in a single day, but those indices routinely rose and fell by more than 5% back in 2020 at the beginning of the COVID-19 pandemic. No one knew what was going to happen, and that uncertainty led to frantic buying and selling. Volatility is often associated with fear, which tends to rise during bear markets, stock market crashes, and other big downward moves. However, volatility doesn't measure direction. It's simply a measure of how big the price swings are. So the stock market works like an auction. Buyers and sellers can be individuals, corporations, or government. The price of a stock will go down when there are more sellers than the buyers. Similarly, the price will go up when there are more buyers and less sellers. A company's performance doesn't directly influence a stock price. Investors' reaction to the performance decide how a stock price fluctuates. Now, this is a very important concept to understand. So, if a company has performed good, but the investors were expecting to post it even better results, so now what will happen? Investors would be disappointed and they will sell the stock. So the sellers will increase in the short term. The stock price will go down despite the company performing good. And this is something very common in the market. And the vice versa of this is also true. See, stock markets are emotional and overreactive relative to the change that is happening in these businesses. In fact, according to some studies, 75% of the stocks move in the general direction of the overall market. In other words, if the market goes up, 3 out of 4 stocks are probably going to rise on an average. The same is true on the downside as well. Unfortunately, when the market drops, most stocks drop along with it. There are obviously exceptions to this, and to understand these exceptions, we have to understand the concept of beta. Well, beta is nothing but a measure of a stock's volatility in relation to the market. High beta stocks are supposed to be riskier, but they provide high return potential. Low beta stocks, on the other hand, provide lower returns and they fluctuate lesser than even the indices. So, if you look at companies that are more stable and the predictability of business is very high, such companies will have lower beta and they will fluctuate lesser than the market. So, there are companies like HUL which has a beta less than even 1. Think of it this way. If a stock rises 1% when the Nifty goes up by 1% and it falls 1% when Nifty goes down by 1%, then the beta of this stock would be 1. There are also companies which fluctuates more than the market. Their beta will be higher. Now you must be wondering what causes these short-term volatilities. See, perceptions and emotions move individual stock prices and the overall market. If investors feel that good times are ahead of the company and the economy, the prices of those securities will probably go up. Investors' perception and emotions are heavily influenced by news events. So, when the government reports one day that unemployment is dropping, the market could do quite well that day. But if another report is released the very next day telling us about an increase in inflation, the market might get spooked and decline. Just as there are quite a few news stories that are released throughout the day, there are many different forces at work which could move the market in either of the sides. Now let's understand what moves these prices over the long run. Feelings, thoughts, and guesses have almost nothing to do with the market. It's all about real profits and interest rates. Let's first speak about profits. When you own shares, you really own a small percentage of a business. So, as the business becomes profitable, the value rises. It's very simple and straightforward. What people think about the future of a company will impact its stock price over the short run, but the actual profits of the company will determine the stock price over the longer period of time. So, why is that volatility important? Why exactly are we discussing it today? See, by understanding how volatility works, you can put yourself in a better position to understand the current market conditions as a whole. You can analyze the risks that are there in the market and you can construct a portfolio that is a great fit for your growth objectives and your risk tolerance. It's important to note, though, that volatility and risk are not the same thing. Volatility matters for those who trade every day or for people who may need to sell their stock soon, such as people who are close to their retirements. But for long-term investors, the day-to-day movements of those stocks hardly matters at all. Volatility is just a noise when you allow your investments to compound long into the future. Long-term investing still involves risk, but those risks are related to being wrong about a company's growth prospects or maybe paying too high a price for that growth. But it could never be volatility. A long-term investor shouldn't be worried about 8 to 10% daily fluctuations. You need to understand that the market is very volatile and any predictions made about a company or a sector can cause it to swing both ways. So, now what to do in these conditions? See, buying good quality companies at fair values which avoid excessive use of debt and diversifying is a great way to lower risk in the markets. Of course, if you're not an experienced investor, then investing in funds can solve a lot of problems. Just go and invest into index funds. And when you get comfortable with the fact that volatility is not actually the enemy, then you will realize that volatility is there to be taken advantage of. Buying shares or funds that you're confident about when they are being offered at good values. So, summarizing what we learned today, volatility indicates the degree of movement in the stock market. Number 2, any predictions made about a company or a sector can cause it to swing both ways. Number 3, volatility reflects the short term uncertainty and it has nothing to do with long term investments. So, a long term investor shouldn't be really worried about 8 to 10% daily fluctuations. Number 4, start with index funds and choose low beta stocks if you are hesitant about directly investing in stocks. Now, as always, I'd like to end the video by giving you a call to action. Go on Google and check about the low beta stocks that are there in the Indian stock market. Get a complete list and check how they have behaved at the time of COVID pandemic. So that's it guys, hit the like button if you liked the video and subscribe to our channel. So basically this video is a part of the whole stock market course that we have created. You can click on the I button to watch our other videos as well. Thank you for watching the video. This is Srijan Barnwal signing off until we meet again.